Thanks for clicking! Canada's real estate market could take off once mortgage rates hit 3%. This according to Robert Kavcic of the Bank of Montreal during an interview with the Financial Post. And while in that widely cited article, the Financial Post spoke to others in the real estate industry who said that the market is going to ignite once we get to 3% and that we are slowly getting there, the bond market shows that, in terms of interest rates at least, we're exactly where we were 8 months ago. Meaning, slowly getting there isn't really close to something we would call grounded in reality.
That's really not important.
And while Friday's news that Canada's unemployment rate is rising has some arguing that the Bank of Canada is going to resume rate cuts, and that may very well be the case, the news coming from China and the subsequent increase in bond yields that came thereafter reminds us once again that the downward march of interest rates is not inevitable. So what I want to do today is go over BMO's argument that 3% mortgage rates will lead to a real estate takeoff, take a look at the data to back up that argument, discuss some recent data complicating that inevitable march, and then go over variable versus fixed in 2025. As we'll see today, while current fixed rates are nowhere near what would be needed for a real estate takeoff, we are expecting to get Canada's national real estate data for April on Thursday, and we'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the Bank of Montreal. On to the interview. As mentioned, BMO's Robert Kavcic says that the housing market likely won't recover until mortgage rates are in that 3% range. Now, regular viewers of this channel will know that the Bank of Montreal has a contrarian history, one that is usually spot on, having called out Canada's housing supply myth long before it became apparent. And this time is no different, with Kavcic noting that one of the reasons BMO wasn't bullish on Canada's spring real estate market activity was that interest rates were not low enough to spur it. And yeah, we had made that point numerous times on this channel during the fall and winter markets that despite the Bank of Canada cutting rates in October, December, January, and March, fixed rates hadn't really changed all that much.
You're making me very upset.
Taking a look at the data, the Bank of Canada 150 basis points ago started cutting rates on October 23rd when the yield on the 5-year was 2.99, and now 7 months and 150 basis points worth of cuts later, the yield on the 5-year Government of Canada bond is now 2.82, barely changing in 7 months' time. Because, and say it with me now, realtors, the Bank of Canada does not set fixed rates. Fixed rates, as we've seen before and will again, are set by the yields in the Government of Canada bond market.
Hello, Mr. Thompson.
So, those interest rate cuts that were supposed to spur the housing market recovery in the spring of 2025 never really materialized, at least in the fixed market, a point that was previewed by the Bank of Montreal last October, well before those tariffs ever materialized, well before Trump was ever even elected. Also, as a brief note, Kavcic also predicted, again back in October, that prices were going to fall on immigration cuts, noting how rents were set to fall. Fast forward to now, and rents, 7 months later, are down for the 7th straight month in a row. Regardless, fast forward to now, and Kavcic says that a 3% mortgage rate would be needed for the real estate market to take off, noting that it makes a lot more sense for a lot of people from an affordability perspective. Which makes a lot of intuitive sense. Looking back over the past 15 years, a mortgage rate with a 4 handle is no doubt going to turn a lot of people off. And given the mortgage rates currently being offered by some of the big banks, that definitely explains at least some of the slowdown that we're seeing in the market. And that 3% threshold makes sense when we look at the math as well. Let's take that Ontario median household income, we'll plug it into Scotia's affordability calculator using that 4.69 interest rate available at TD, and we get a purchase price of $435,000. But when we change that to 3.69, we get a purchase price of $482,000. So that difference between 3 and 4% leads to an additional $50,000 in buying power. Definitely enough to move the needle for a lot of home buyers. So rates needing to be closer to 3% for the market to ignite, it does make a lot of intuitive sense. As we've seen, it makes a lot of mathematical sense. Let's also take a look at history. Let's look at the past 15 or so years to see if it makes historical sense as well, just to be sure we're not being fed a load of self-serving propaganda.
No one would do that.
Let's grab the fixed rates for the past 12 years from Stats Canada, and we'll match them up with the benchmark price from the Canadian Real Estate Association. We'll plug all of that data in those graphs into After Effects, make it look nice, and get the following graph showing the average 5-year fixed insured mortgage rate since October 2013 and the benchmark price of a home. Looking back over the past 12 years, we can see that there was really only 2 time periods where interest rates rose above 3%.
I'm an entrepreneur.
No, but seriously, if we look back at those 2 time periods where rates rose over 3% between April 2017 and August 2018, and of course post-COVID, we can see that in both time periods, the benchmark price actually fell, as rates rose above that 4% threshold. So yeah, there is some historical credence to Robert Kavcic's argument that if interest rates have that 3 handle, if they are in and around that 3%, that's enough to spur a real estate takeoff. But if they have a 4 in front of them, don't expect the real estate market to take off anytime soon. So that begs the question, what are the chances of us getting that 3% mortgage rate anytime in the near future?
1 week.
Well, as we saw last week with the US-UK deal, and as we saw on Monday when Treasury yields continued to spike upward on the US-China trade truce, and as we've talked about at great length on this channel for the past 4 or 5 months, any progress in this Trump trade war, any appearance that the tariffs are going away, will lead us back to the original problem that we had pre-Trump tariffs. Continual sticky inflation. Yeah, there's a real worry out there that even with tariffs on China dropping to only 30%, that the global trade war started by the 17-dimensional grand chess master himself, President Trump, can and will cause inflation in the United States. According to a recent article in the Financial Times, a number of economists are predicting by summer, those tariffs will start to materially increase inflation, as by then, U.S. companies will have exhausted existing inventories, meaning those companies sold old stock at old prices, but as new stock needs to get replaced, as their inventories need to get refilled, they'll be refilled at those new tariff-included prices. So, if I'm an investor and I'm going to be loaning the United States $1.3 trillion over the next 6 months, and I know that inflation is going to be increasing, ergo when I get that $1.3 trillion back, it's not going to buy as much as it did 6 months ago, I'm going to demand a higher interest rate from the United States. I'm going to demand a higher yield on the bond that I buy. And that's how the Federal Reserve can cut interest rates by 100 basis points since the fall. Yet, the yield on the 10-year Treasury is up 80 basis points since that same time period. So, with rates not set to decrease anytime soon in the United States, and the yields on Canadian government bonds being pushed up as well because of it, those 3% mortgage rates are probably not at all in our future in the immediate term. Now, maybe those who spoke to the Financial Post about interest rates slowly getting to 3% may have been talking about variable, which could be headed that way, especially with rising unemployment pointing to a central bank that could be more in the mood for easing than they were a few months ago, which very well could turn out okay. Over the next year or so, we probably will see more central bank rate cuts, though I would caution that under the current time period, taking a variable rate is not one of those set it and forget it type of situations. Even Rob McClister, the one-time cheerleader for variable rate mortgages, has recently started to warn against rolling the dice on variable given current uncertainties. Last time variable rate usage started surging to current levels was back in 2021. In fact, while variable rate usage was doing this in 2021, bond yields were doing this, warning about potential inflationary pressures. But yeah, it's definitely possible that the Bank of Canada will opt to lower its policy rate, opt to target the Canadian economy vis-a-vis the real estate sector, which, real estate alone, constitutes 13% of our GDP. So we could in fact see some lowering of floating rates, but when we look at fixed rates, because of pressures coming out of the United States, it's not looking, at least for now, like fixed rates are going down to that 3% anytime soon. As such, if we're not going to be seeing fixed rates down to that 3% anytime soon, as Kavcic says, then I wouldn't expect to see real estate take off anytime soon either. And that's just the interest rate part of the equation, let alone the employment and uncertainty part of the equation, which is gaining more and more salience. So there it is, right in the numbers. We saw it intuitively, mathematically, and historically. If interest rates are not in that 3% range, if mortgage rates don't have a 3 handle, then we rarely, if ever, see the real estate market take back off. Given that what's coming out of the United States is keeping bond yields high with or without the tariffs one way or the other, it's unlikely we'll be seeing those 3% rates anytime soon. With that said, we will continue to track Canada's mortgage rates on this channel and how they affect the real estate market. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.